Everyone, this is another episode of Know Before You Owe. Brian Parker with the Brian Parker Group. Today we talk about, as I jokingly say it, pity me and ho ho ho. But in all seriousness, we're going to talk about PITI, maybe some MI, and HOA. And it's really these three things that go into your total monthly housing expense if they're all applicable. And I've been doing this 24 years, and it never surprises me how many people I talk to that don't really know what makes up their total mortgage payment and what can change and what might not be able to change. So we're going to do a quick walkthrough here. And if you've already seen this video or you kind of know what goes into it, you can pause it, go to the next one. We'll have more content for you, and we continue to educate the people that are out there looking to know about mortgage financing. So PITI-MI-HOA, what does that consist of? Well, P is for your principal. That is a fixed rate. It will not change if you are on a fixed rate mortgage, whether it's a 30-year fixed rate, 15-year. As long as it is a fixed rate mortgage, that amount will never change. If you are on adjustable rate mortgage, which we haven't seen too many of those over the last several years because market volatility and the rates just are not terribly competitive. Most fixed rates are better than an adjustable rate. You have a 5-year arm or a 7-year arm or a 10-year arm, then that principal payment could change once your arm is due for adjustment. But if you're on a fixed rate, that principal payment will never change. I is your interest. That is the amount you pay each month on the amount of money that you borrow in your mortgage loan. The interest that you do pay does decrease each month as you pay down principal on your loan. Now, a note here, any month that you pay more than your standard principal and interest payment, if you dedicate that extra amount toward principal, you will be paying off your interest much, much faster. And as an example, on a 30-year loan, if you make one extra principal payment per year, whether you do that as a lump sum or just divide that by 12 and add that to your monthly payment, one extra principal payment per year, you will pay a 30-year loan off in about 22 and a half years. If you do two extra principal payments a year per year, you will pay a 30-year loan off in about 16 and a half years. So great way to pay your mortgage down. Kind of almost give yourself a 15-year mortgage, but with a 30-year payment and not be obligated to a 15-year mortgage payment. And you can still accomplish the same thing by paying extra principal. Next piece is your taxes. This amount can change based on when your city or county will readjust your tax value and your tax rates. I know the couple of areas we have our homes in, most reevaluations take place about every 5 to 7 years. Even if your mortgage is escrowed for your mortgage payment to pay your taxes and insurance each year, you will get a copy of your tax bill and your insurance bill each year from the county and from the insurance provider because you are the homeowner. Feel free to reach out to your mortgage lender if you have any questions to make sure they received a copy of those updated bills and statements. But that amount can change, but we set your mortgage up based on what the tax bill is with the city and county based on when you buy your home. Your insurance can also change based on if you have insurance premium increases, if you file claims against your properties, if you make any changes in your deductibles and coverages. But what we've seen a lot over the last couple of years with rising insurance premiums and rates, you're likely just to get an increase in premium because the cost of insurance is going up. And depending on what state you may be in, some states, there's a lot of insurance companies that have been backing out of insuring in certain states or certain areas of the state, depending on where you may be located at. So your PITI, that is your mortgage payment, but you may also have MI. And your MI is your mortgage insurance or your monthly PMI premium. On a conventional loan, that amount really will not decrease each month, even if your balance goes down. It's going to be on your mortgage until you have enough equity in your home for it to automatically drop off when you have 22% equity in your home based on principal reduction or also appreciation on the property. If you are at 20% equity, you can contact your servicer and request for it to be dropped. But most likely, the servicer is going to require an appraisal for you to pay to do that. On certain other loans, such as a USDA loan and so forth, as your principal payment goes down, that monthly insurance premium will decrease. There are some programs like a standard FHA loan that's 3.5% down. That PMI will never go away unless you refinance the loan. So PITI and MI, that together could potentially be your total mortgage payment if your mortgage does need private mortgage insurance as part of the loan. And then your last part is your HOA dues. Not all homes have HOA dues. If you're in a situation where your subdivision, your complex, your townhome, condo, you have HOA dues, those dues may be due quarterly, annually, or even monthly. And they do get counted into your total housing expense. So when we're doing your pre-approval and qualifying, all those items together is part of your qualifying and your debt to income ratio. But your HOA dues are not part of your mortgage payment. You will have to pay those separately. Typically, though, when you purchase your home, if there is any HOA capital contribution due, maybe you have dues that are payable for the first quarter that you'll be rolling into with the new association and your subdivision or whatnot, they'll get paid at closing. But once that's completed and you're into your regular cycle, you'll get those bills as deemed by your HOA. So that is your Pity Me with your ho ho ho, PITIMI and HOA. If you have any questions, please reach out to me. I'm glad to share the slide with you. Just let me know. It's Brian Parker with the Brian Parker Group. God bless you. I hope you have a most fantastic day. See you next time.